are on silent. 5 rates. Okay, so journal entries. First journal entry, Nazami invested $30,000 cash and computer equipment worth $20,000 in the company. So what's the journal entry here? Debit cash. For how much? Okay. Debit computer equipment. For. Okay. Credit capital. For the total of the two. All right, April 2nd. April 2nd says the company rented furnished office space by paying $1,800 cash for the first month's rent. So what's the journal entry here? So debit rent expense. And because we are recording, there should be no talking other than responding to me. Debit to rent expense, credit to how much?
$1,800.
April 3rd. The company purchased $1,000 of office supplies cash. What's the journal entry here?
Debit cash, debit office supplies, debit cash.
Debit office supplies. Credit cash, how much? 1,000. April 10th. The company paid $2,400 cash for the premium on a 12-month insurance policy. Coverage begins on April 11th. What's the journal entry here? Debit, prepaid insurance. Thank you. 2,400 credit, cash. April 14th. Says the company paid $1,600 cash for 2 weeks' salaries earned by employees. So what do we debit here?
Salary expense.
Salaries expense. Credit.
Cash.
1,600. April 24th. The company collected $8,000 cash on commissions from airlines on tickets obtained for customers. So what's the debit here? Cash. Credit. Commissions earned. Bless you. All right, April 28th, the company paid $1,600 cash for 2 weeks' salaries earned by employees. Debit salaries expense. Credit. April 29th, the company paid $350 cash for minor repairs to the company's computer.
Repairs and inventories.
So debit, repairs expense, credit,
Cash.
cash. All right, April 30th, the company paid $750 cash for this month's telephone bill.
Debit telephone expense.
Credit,
Cash.
and the last one for April 30th was to, Nozomi withdrew $1,500 cash from the company for personal use. So what do we debit?
Withdrawal.
Withdrawals, credit,
Cash.
okay. So that's the first step of the accounting cycle. What's the next step? General ledger accounts, and we have, I believe, a total of 16 of them, right?
Right.
So I'm going to set these. You have how many?
9.
All of those?
Oh, okay.
All of them, even if they had a balance or not. All of them. You have to write on the back. Yeah. Yes, ma'am.
Does the general ledger go in the right order, or do you just do?
Because they've given you this like this, with those, you see those numbers that are going chronologically, you have to do it in that order. But if they don't give it to you, you can put it in whatever order you want.
Does it go this way?
It doesn't matter which way you do it. So we have cash, accounts receivable, office supplies, um, and hopefully you are using a pencil because you will do a lot of erasing and changing some things. Accumulated appreciation.
Payable.
Capital. All right, so I'm gonna start recording in these T accounts what we have so far as the journal entries are concerned. You guys get the previews on them? No. So credit. April. Second, yeah, the debit to rent expense on a credit to cash for 18 weeks. They paid rent.
Okay, so This is the premium for the 18.
the cash.
I have a question. Do you know if y'all have entered on the number for the account?
Still listening,
Why?
because eventually you'll have something that goes on.
Something else, is this a zero or just leave that empty?
You can leave them in because we know that they're zero. What will happen is you guys gotta keep in mind, remember the accounting cycle. Eventually we will make adjusting entries, which will require you to use those things that were zero balance now. They won't be zero after adjusting interest. Do you guys have this? Okay, so we've recorded everything in the T account, and before we can move on to an unadjusted trial balance, we have to do what? We got a total deed. You don't know what the account totals are, right?
No.
So for cash, give me an amount. AR, we know is zero. We don't have to write anything. For right now, supplies is 1,000 on the debit side. Prepaid insurance for now is 2,400 on the debit side. Computer equipment for now is 20,000 on the debit side. Accumulated depreciation is zero for now. Salaries payable is zero for now. Capital, the balance is 50,000 credit side for now. Withdrawals, 1,500 on the debit side for now. Commissions earned, 8,000 on the credit side. Depreciation expense empty for now. Salaries expense, 3,200 on the debit side for now. And before I go to the next page, let me make sure you have those.
Cash on the credit side, 9400. Debit, for the debit card? On the credit side, debit is 38,000. There's the debit balance.
Okay. The next page here. Okay. Insurance expense zero for now. Rent expense 1,800 on the debit side. Office supplies expense empty for now. Repairs 350 on the debit side. Telephone expense 750 on the debit side, and zero for income summary right now.
Why we got debit on the card? I mean, nothing on the insurance, on the prepaid insurance.
It was something on the prepaid insurance. This is insurance expense, not prepaid insurance.
Oh, okay,
Yeah, we haven't done anything with that yet.
okay. Okay, prepaid, okay.
So we balanced them. Now we should be able to do an unadjusted trial balance with the accounts we do have available to us, regardless of whether or not they have a zero balance in the unadjusted a trial balance. They still must be listed. So this is the worksheet that you need to pull up. We are going to write the accounts here. We have cash. We have accounts receivable, office supplies, prepaid insurance, computer equipment, accumulated depreciation for the computer equipment, salaries payable, capital, withdrawals, commissions earned, depreciation expense, salary expense, insurance expense, rent expense.
Well, I can get it.
It's okay, I'm writing it again. It looks muddled. I'm rewriting it.
Oh, okay.
I don't think it's one in here. So those are the accounts that you need to have listed. Let me know once you all have this down. You guys have this?
Yeah.
Okay, so did anybody figure out what that cash balance was? $27,000. Okay. So now we're here, and so we have all of our balances. You said cash was 27,000, correct? So that goes on the debit side. Accounts receivable, 0 for now. Office supplies, 1,000 on the debit side. Prepaid insurance, 2,400 on the debit side. Computer equipment, 20,000 on the debit side. Accumulated depreciation, 0 on the credit side. Salaries payable, 0 on the credit side. Capital, 50,000 on the credit side. Withdrawals, 1,500 on the debit side. Commissions earned, 8,000 on the credit side. Depreciation expense, 0 on the debit side. Salary expense, 3,200 on the debit side. Insurance expense, 0 on the debit side. Rent expense, 1,800 on the debit side. Office supplies expense, 0. Office supplies expense, not office supplies. Repairs expense, 350 on the debit side, and telephone expense, 750. What are the totals of these two columns in the unadjusted? Said on the credit side is 58,000.
Yeah.
Okay. Just double check the debit side to make sure they should be full. Pull off in. Does it equal 58,000?
Yeah.
All right, so now that we have this unadjusted trial balance, we have to do what? How do we adjust? Adjusting entries, right?
Yeah.
So we'll come back and fill out this adjustments column after we record our adjusting entries. They give you, under number 4, the adjustments. A says 2/3 or $133 of 1 month's insurance coverage has expired. So our adjusting entries, $133 has expired. What do we debit? You do understand. It told you that 2/3 or $133 of 1 month's insurance coverage has expired.
Debit, insurance expense, and you credit prepaid insurance.
Yes, ma'am.
Where do we go back? To this at the bottom?
That's fine. However, if you write it on paper or what I've given you, that's fine.
Okay.
Please don't make it be complicated.
Okay.
So, Cesar, you said a debit to
Insurance expense,
insurance expense
and a credit to prepaid insurance,
and a credit to prepaid insurance for how much?
$133.
Letter B says at the end of the month, $600 of office supplies are still available. So if $600 of office supplies are still available and the account started off where the balance currently is $1,000, that means how much supplies have been used?
400.
400. So what is our adjustment entry here?
Supplies expense.
Debit to office supplies expense.
Yes. And credit to supplies is $400.
Credit to office supplies, 400. Letter C says that this month's depreciation on the computer equipment is $500. So what's the adjusting entry to record here? Depreciation expense is a debit for 500. And what do we credit?
Accumulated depreciation.
Accumulated depreciation for 500 as well. Letter D, employees earn $420 of unpaid and unrecorded salaries at the end of the month. So what's the adjusting entry for this? Debit to salaries expense and credit to
Salary, payable.
For 420 or 420.
Yeah.
Letter E says the company earned $1,750 of commissions that are not yet billed at month end. Debit accounts receivable for $1,750 and credit what? Commissions earned. So these are all the adjusting entries that we had. At this point, we have to go back and correct what before we can do an adjusted trial balance? The T accounts, right? Because some of them changed. Do you have this before I go back a couple of slides?
No.
Okay, do we have this? Yeah. All right, so now you need to go back to your T accounts paper. And we need to change some things. First, starting with insurance expense. Now we have a debit of 133, which makes the balance 133. And then we need to go back to prepaid insurance because now it decreases by 133, which means the new balance is what? Decreases by 133.
2,277.
So now we have a balance of 2,267. Office supplies expense increases by 400. So that means the new balance is 400. And then write that quick before I switch. You got to keep up. I'm the one doing most of the writing. Office supplies decreases by 400, which means the new balance is what? 600. Mm-hmm. Depreciation expense increases by 500, which means its new balance is 500 on the debit side. And accumulated depreciation increases on the credit side by 500, which means its balance is 500 on the credit side. Salaries expense increases by 420, which means the new balance should be what?
Salary expense, okay.
And salaries payable increases by 420 on the credit side, which means its new balance is 420. Accounts receivable increases by 1,750 on the debit side, which means its new balance is 1,750. And commissions earned increases 1,750, which means its new balance is what? 9,750.
And what goes under adjustments?
We're about to put it under adjustment.
Okay.
Okay. So, do you have this?
Yeah.
All right. So go back to your worksheet now. And now we're in these two columns, the adjustments column. And was cash affected at all?
No.
So we don't need to change it, which means we can bring this 27,000 over to where? Adjusted trial balance on the debit side, 27,000. So it doesn't change. And what I think I may do, just for emphasis, All right, accounts receivable. Did we adjust accounts receivable?
Yes.
How much?
1750.
Increase or decrease? Debit side?
Debit side.
So you're gonna place 1750 here, and that you're gonna place the new balance, which is also 1750 here.
Okay, hold on.
Office supplies, is it still $1,000 balance?
No.
Did it decrease or increase?
Decrease.
Decrease.
$400.
So we're gonna place $400 here in this credit column, which means the new balance is what? 600 on the debit side. Did prepaid insurance change?
Yes.
Increase or decrease? Decrease, how much? 133, which means the new balance is what?
2,267.
2,267. Did computer equipment change?
No.
No, so we can just bring that balance over. 20,000. What about accumulated depreciation?
Yes.
Increase or decrease?
Increase.
How much?
500.
So we're gonna put 500 here and also bring it over here. Bless you. Salaries payable, did it change?
Yes.
Increased or decreased? Decreased?
Increase.
Increased.
420.
420. So we're gonna put it on the credit side here and also bring it over in our adjusted trial balance on this credit side. What about capital? It didn't change, so we just bring that 50,000 over. Withdrawals, did it change?
No.
No, so we can just bring that 1,500 over. Commissions earned,
Yes.
it changed, did it increase or decrease?
Increase.
Increased, by how much?
4,750.
1,750, which means our new balance should be 9,750 on the credit side. What about depreciation expense?
Yes.
Increase or decrease?
Increase.
How much?
500.
500. So we're gonna do 500 here and also bring it here. What about salaries expense?
Increase.
Increased, by how much?
420.
420. So we're gonna put 420 in this column. What's the new balance of this account?
3,620.
3,620. And what about insurance expense?
Increase.
Increased by how much?
133.
133, which means the new balance is 133. Rent expense did not change, so we just bring it over, 1,800. What about office supplies expense? Increase 400. So we're going to increase it 400, and the new balance is also 400. Did repair expense change?
No,
Telephone expense?
no.
So we just bring those over. And now you need to calculate what the new balances, the new totals are. Bless you. Also total these adjustment columns. Yes. If I'm right, this comes out to 3203. And so does this. $60,670. This is what you guys have?
Yes.
All right. So now that we have this, we can fill out these income statement columns and balance sheet columns and then do the actual statements. So an income statement, what goes on the income statement? Revenues and expenses. And so we got to come all the way down here, right? Commissions earned, 9750 here.
Okay, hold on. Okay.
500 for depreciation expense, 3620 for salaries expense, 133 for insurance expense, 1800 for rent expense, 400 for office supplies expense, 350 for repairs expense, and 750 for telephone expense. Now, in order for you to get net income or net loss, what do you have to do?
Expense from, commission earned.
Subtract expenses from revenues, or in this case, commissions earned, and what do you get?
Okay, hold on.
What do you subtract in order to get net income or net loss? Subtract expenses from revenue, or in this case, expenses from commissions earned. What amount of net income did you come up with?
2,197.
2,197. Now what goes on the balance sheet? What accounts go on the balance sheet?
Assets.
Assets, liabilities, and owner's equity. And what goes on the statement of owner's equity? Capital, withdrawals.
Net loss and net income.
Uh-huh. Okay, so we know for balance sheets purposes, we can bring cash. That is an asset. Accounts receivable is also an asset. Office supplies is also an asset. Prepaid insurance is also an asset. Computer equipment is also an asset. Accumulated depreciation is a liability. Salaries payable is also a liability. Capital, that's equity, right? So we're going to do, bring 50,000 over here. I'm sorry. Take the parentheses off of those. Withdrawals go here as well, right? And that's it for this row, except for we're going to add net income at the end. So as of right now, 500 plus 420 plus 50,000. 50,920. All these, excluding this, because we know we subtract that. But all of these added together equal what?
$51,632.
So our assets equal 51,617. And so we know that liabilities and equity added together should equal what? This number, right? And yes, ma'am.
Why is withdrawal instead of
Because you're supposed to do what with withdrawals on the statement of owner's equity. So at this point, we have our 50,920 here, right?
Right.
So we need to subtract first withdrawals, right?
Yes.
And then you need to add what? Net income. And tell me what that amount is. How much is it?
It's 2,197. It's 3,697.
Right. Did you plus? You were supposed to take this amount, subtract this, but add that.
Oh. $51,617.
So it equals out to 51,617, which is where we want to be, right?
Right.
Okay.
Okay, so you added the total assets,
No.
no?
Subtracted.
You added liabilities plus owner's equity, and you subtracted withdrawals and added net income.
Okay, so.
Added liabilities plus owner's equity, subtracted withdrawals, and added net income. Do you all have this?
Hang on. So once again, you subtracted the liability from the asset. That's not right. Yeah.
What you shouldn't be, and I'll tell you why. All you see here is two columns. I asked you what was on the balance sheet, right? What did you tell me?
Assets, liabilities, and equity.
And in order for what should equal after you're done?
Assets, liabilities, and equity should equal the equation.
Liabilities actually should be equal to the assets.
Correct. So why are you confused? Because that's exactly what we did here. All this is assets. That's the total amount for assets. So we're trying to equal this, right, with liabilities and equity. The only thing you're missing from equity here is what?
The net income.
Withdrawals and net income. Now, we're about to do the statement itself, and withdrawals won't be on there. Nor will net income, because that goes on what statement? Statement of owner's equity. So the first statement for us to do is what?
The income statement.
Income statement, and what goes on income statement?
Revenue.
So what do we list first?
Revenue.
What are they calling it in this problem? Commissions earned, and what's the balance for that?
9,750.
9,750. What's next? Expenses. What are the expenses we need to list?
Insurance expense, rent expense, security expense.
Start list them in the same way we've been listing them.
Oh, okay.
So depreciation expense, which is how much?
500.
500. Salaries expense.
3,620.
Thank you. Insurance expense.
233.
Rent expense.
1,800.
Office supplies expense.
400.
Repairs expense.
350.
Telephone expense.
750.
And what did you say the net income was?
2,179. I'm sorry, So, no, 2,197, I apologize.
Okay.
Okay, that's it. I had moved.
That's all you have to have for your income statement. And then we'll go on to the statement of owner's equity. I think so. Did everybody get this? Okay. Statement of owner's equity is the next statement. And what do we start off with on the statement of owner's equity? Beginning capital. Beginning capital is going to be what amount?
55.
Beginning capital is going to be what amount?
50,000.
Beginning
Oh,
capital.
zero.
What's next? Add what? Investments. How much were investments? What else do you add?
Net income.
Net income or net loss. How much is that?
2,197.
So that should equal 52,197. Then you subtract out what? Withdrawals. How much is that?
1,500.
So that means your ending capital amount is going to be what?
51,617.
50,697. Okay, you guys have this? All right, so now the balance sheet is the next statement. And we start off with our assets, which are cash, accounts receivable, office supplies, prepaid insurance, computer equipment. Accumulated depreciation. So what was the amount of cash? 27,000. Accounts receivable, 1,750. Office supplies, 600. Prepaid insurance, 2,267. Computer equipment, less accumulated depreciation. What are the total assets? This here. 2,500. What amount did you get? What did you get? Y'all wasn't adding all that time and I just wrote all this stuff. Salaries payable. What's the balance of salaries payable?
420.
420. What about capital?
50,000.
Is capital still 50,000?
Oh, no. 50,697.
So that means total liabilities plus equity equals what?
Same thing, 51,117.
Who just said that? What did you add?
I have everything that you have.
Did you subtract out accumulated depreciation?
So I think that was my only difference. I didn't, I had that at 20,000 instead of 18,000.
It's 19,500 after equipment subtracts accumulated depreciation. What's the next thing to do?
Post-closing insurance. Oh, yeah, sorry.
Closing journal entry so that you can complete a post-closing trial balance. Do you guys have this before I go to the next thing? Alright, so closing entries. What are the 4 steps of the closing process?
And somebody next by the time.
You can write this on a separate sheet of paper, write it on the same sheet, it doesn't matter. All of these entries would be dated April 30th. Now, what was step 1? Close what? Close revenue to income summary, right? In order to close revenue, you have to do what to it? Debit it. Because its normal side is credit. So we're going to debit commissions earned for what amount?
$9,750.
$9,750, and we're going to credit what?
Income summary.
Income summary. What's step 2? Close what to what? Expenses to income summary. So we're going to do what to income summary? Debit or credit it? Debit and credit what? All the expenses, right? So we have depreciation expense, salaries expense, insurance expense, rent expense, office supplies expense, repairs expense, telephone expense. What should income summary equal?
The total of the expenses.
What is it? Say it again. $7,553. What's step 3? To so in order to close income summary to owner's capital, what do we debit? What do we credit? Debit what? Debit income summary and credit what is the amount? $2,197. And does everybody know how we got that? Is there anybody that does not know how we got it? Cool. How do you get the income summary amount? Everybody should know this. This is the chapter we currently on. You debited you credited income summary up here, right?
Yeah.
Which is the normal side. You debited it here, which means you need to take this number and do what? From here, right?
Yeah.
Which equals the balance that's in there, which is what we're closing into capital. What's step 4? Close withdrawals to capital. What do we debit? What do we credit? Debit capital, credit. What's the amount? Yes, ma'am.
Is it important that we have to list the income summary before we list all the expense? That has to come first. Just like for the commission line has to come first before the income.
Why? Why is that? Because in order to close an account, you have to do what to it? The opposite of its normal balance.
Okay.
So the normal side for revenues is what?
Credit.
Which means you have to do what to it to close it to zero?
Debit.
And the normal side of expenses is what?
Debit.
And in order for you to close them, that means you would have to do what?
Credit.
Credit them. And income summary, which is a temporary account, its normal side is credit. So you have to debit it in order to close up to zero. Do you guys have this or still writing?
Yeah.
Still writing.
Got it? So now the last final step is to do what? Post-closing trial balance, which is only going to include what accounts at this point? Permanent accounts, because we closed out all the temporary accounts. So the only thing we're listing are permanent accounts such as cash, accounts receivable, office supplies. Thank you. Computer equipment. Accumulated depreciation. Salaries payable. And capital. Total those up. So cash, we had a debit balance of 27,000. Accounts receivable, a debit balance of 1,750. A debit balance of 600 for office supplies. Prepaid insurance, 2,267. Computer equipment, 20,000. Accumulated depreciation for that computer equipment is 500 on the credit side. Salaries payable, 420 on the credit side. And capital, that new balance is 50,697, which means that these totals should be what now? You tell me what amount you come up with. $1,617. Okay.